Hi, Dominique, and welcome to another week of our kind of week ahead video for investors. Sorry, last week. Well, I guess it was kind of Easter weekend. It was also, I guess, Passover, Ramadan still going on, so it's a mix of many holidays. So, but it's good to be back and to get your thoughts. Obviously, this was probably even maybe more volatility or turmoil we've seen in certainly in risk markets, and we've seen that in probably a while, maybe the last kind of several weeks. So, any big takeaways from the previous week, and then let's dive into the events from IMF meetings this weekend, and obviously the key events for the week upcoming.
Yes, what an exciting week. I got stronger conviction on my close to 8% Fed funds rate call. I mean, this was absolutely fascinating. Basically, this is a week when the market decisively lost confidence in the Fed inflation fighting abilities, because you had two things happen at the same time. First, long-term inflation expectations, so five-year B broke from the range they were in over the past 5 years, so between 1.5%, 2.3%. Now they are close to, I think, about 2.5%, but this was a really big move. And the best part of it was that it happened while indicators of market expectation on Fed policy. So I used, for instance, the 2-year, 1-month OIS swap. This moved to a post GFC high to, what is it? Let me show you. Let me share my screen. So here you go. I mean, here is a 2-year, 1-month OIS, and it's close to 3%, which is post GFC high. The last time we were there was in late 2018. And look at long-term B is almost 2.5%. So I think what's happening here is that market participants are looking at inflation. It's 8.5%, and then they look at the Fed terminal rate, 2.8%, and they think that 2.8% when inflation is at 8.5% is not much of a terminal rate. So they are losing confidence for good reason, in my view.
Yeah.
And then the other aspect of it, which I thought was really fascinating, I think the Fed is also losing confidence in its own inflation framework, because basically we had Fed officials this week tell us that they want to get to their estimate of a neutral Fed funds, which is 2.5% by the end of this year. And only 5 weeks ago, in the March FOMC meeting, they had penciled in as a median 1.9%. So, I mean, when you change your mind that quickly, when there is really no new information, it shows you just don't believe in your long-term framework and your long-term view. So I feel quite good about all this, because I know I'm a bit out there. What is it that the Brits say, over the top with my 8%, but the core of the 8% is that the Fed estimate of the neutral rate, so of the rate they have to hit to bring down inflation, I think it's deeply flawed. So from my perspective, this was quite a good week. Let's see what happens.
Are you concerned? I mean, if the stock market came off 15%, I mean, there's a point that, high yield starts kind of showing real fractures. Like, is there a point? I mean, I guess in the short term, the Fed's okay with some of that, but in the medium term, can the economy withstand that? If Europe goes into recession, will the Fed continue to hike?
Oh, the Fed, unfortunately, got itself into a nasty corner. They are in the same situation they were in the 70s when unemployment was rising, inflation was rising. They were very reluctant to hike because of unemployment. Eventually, they had no choice. I think this time around, what makes the situation even more painful from their perspective is that the economy is much more financialized. So, but it's still the same story. As long as inflation is not on a sustainable downward trajectory, they have to hike. The one thing that could make them pay attention to the market is if suddenly we had systemic issues. Say we had a systemic lender that,
Fine.
was
That was
like,
way over levered or something. It looks
something
like that.
like that. But
Yeah.
frankly, the Fed has been singing forever about the strength of the bank's balance sheet. So I find it highly unlikely. I think the sad reality is that the Fed put is gone until
Yes.
inflation goes back to the 2%
Yep.
target.
Okay. Okay. So just your general view. So what's market-wise, what's your, I don't know if I have even asked you, like, so what's your favorite way of playing this view?
Cash, just joking, sorry. Well, it's not looking good, neither for bonds nor for equities. But I do think that at some point the curve is going to invert.
Yeah.
We are not there yet. I think what's going to happen is that we're going to have a little game played between the Fed and the market, so that before each meeting, the market is going to start pricing 50 basis points. Right now, the 50 basis points are priced up to the July meeting. But as we get to the year and inflation remains sticky, so they'll price 50 basis points. Then the Fed will not have the guts to hike less than the market is pricing because inflation is so high. And at some point, I think there's going to be a sort of capitulation by the Fed, where they just give up on their 2.5% neutral Fed funds, and they go close to my target of 8%. And at that point, I think there is a big sell-off in equity and a big curve inversion. And that's when we get a recession. And I think, if you look at the number of quarters between the first Fed hike and the recession, it's been, since the 1960s, it's been between 6 and 15 quarters. But I'm starting to wonder, given how financialized the economy is, and that this time around, the Fed is telling us ahead of time where they want to go, whether we could not have the recession faster than in previous episodes of Fed tightening. So maybe the recession starts in early 2023. So that's kind of my market scenario. So, I mean, what do you want to own? Volatility, maybe.
Right.
And the thing is, one interesting aspect of this is what happens to real rates. They've really gone up. There is this BIS view, and by the way, the BIS is on my side in terms of critiquing the Fed framework. There is this BIS view that the reason real rates have been so low globally is because central banks have been so loose, all of them, and they have data work to support it. And so now we have this huge global inflationary shock. And so there is, in my mind, a very valid question. If global central banks start tightening all at the same time, are we going to get a big increase in real rates? And it seems to me that's what's exactly is happening now. So higher real rates wouldn't be good for things like gold, for instance. So again, in terms of, what do you own? Volatility, I would think.
I mean, it's also, I think Bilal was pointing out, that developed market inflation is higher than emerging markets inflation.
For sure.
And in some, which is in our lifetimes, I be unfathomable to think that until like the last couple months. I still think that we could see real, where would be real kind of volatility or fractures in the economies would be maybe in emerging markets too. I think after 150, 200 basis points from the Fed, that alone could really kind of spook markets and spook in emerging markets, especially if growth starts slowing. Because if rates start getting close to levels at nominal rates in developed markets as they're in emerging markets, and growth is generally slowing in the world, I can't imagine that's a good environment for emerging markets. But
definitely. And so since you were mentioning the IMF meetings, there was a fascinating panel.
Yeah. So do you want to quickly go over? So it's happening this weekend.
It happened last week.
Couple days.
That's left this weekend is women, the environment, and other soft-nosed but noble causes.
Right.
There was this roundtable with Powell, Lagarde, the finance minister of Indonesia, and you could see that the lady, so Sri Mulyani, she really saw the writing on the wall about the Fed and eventually the ECB, because the idea that the ECB is going to remain dovish. Come on, where is the German fear of hyperinflation? So that poor finance minister from Indonesia could really see the writing on the wall, and she was thinking that it would not be a good time for emerging markets. So definitely. And
I saw something in Mexico was also saying something similar. I mean, it is what it is. I mean, we all agree, like US, Europe alone has to get inflation under control. And some of the collateral damage probably will be in emerging markets. Any other key things to take out from these meetings?
Yes, I think in the US, we're probably going to see a cut in import tariffs on imports from China. I mean, so what was fascinating about these meetings is that they were the first meetings after the invasion of Ukraine by Russia. And so we got a sense of what this crisis did to global cooperation and how countries were likely to react. And on the US part, there was an absolutely fascinating speech and comments actually by Yellen, where she said, an embargo on Russian energy export is not a good idea. I mean, obviously, that would raise gas prices that already are sky high in the US. She didn't think that China was breaking or weakening the sanctions on Russia, despite China
and 100% they are, but
of course. But the plot here is that the administration is so desperate about the high inflation rate. It's releasing oodles of gas of petroleum from the strategic reserve. So they are so desperate that they've decided they are going to cut imports tariff and to make it politically acceptable. Of course, China has to be exonerated of any attempt to weaken the sanctions against Russia. So I don't think this is going to help much with inflation, by the way, because we saw what happened when the tariffs were raised. There was an impact on the price level, but not on the rate of change of price, which is what inflation is. Yeah. So we'll have a little bit of a one-off, but not much of the last impact.
Well, I guess if the administration can point to that pre-midterms, even if we agree that it doesn't really fundamentally change things and probably sends a weak message, I guess they want to show some wins, and I guess this would be kind of.
Yeah,
but just thinking in there, yeah.
you will have the GOP on the other side accusing
Oh,
them
right.
of selling the soul of, I don't know, US patriotism or whatever it is, US
Yeah.
exceptionalism for a few
Yeah.
bucks. And by the way, they would do exactly the same thing as the administration if they were in power. So
Yeah. And both sides probably agree it's probably not the right thing for the country, but in the in the short term,
yeah,
listen, this is a difficult global situation, very difficult situation, and getting more complicated, as time goes on, and um, everyone's kind of figuring out like how do you play hard with who your frenemies are, but keep your economy, US, us in the US, we have difficult choices, but obviously parts of Europe have even more difficult choices. How do you do the right thing for your country and for what you believe morally right in the world, but at the same time, how do you stay in power, or how do you kind of,
totally.
it's a tricky one.
Yeah.
And then, okay, fine. So anything else for takeaway in that, or should we think about, I know you're mentioning there's a lot of interesting data coming up. And quick question, there was some talk about 75 basis points, maybe not at this meeting, but the follow-on, this upcoming meeting in May, but the follow-on two meetings. I think a few banks are now, or one bank's calling for that. Do you see that as a possibility?
No, it's too soon, unless I think we will get to there. But we need the Fed, the Fed is emotionally attached to its inflation model. The expectations augmented Phillips curve. There was a big speech in 2015 by Yellen where she explained, how it was driving Fed policy. Also, this expectation model basically gives central bank a lot of credit for low inflation during the 1990s, basically up to the financial crisis. And in all fairness, some of it is probably due, but I think they have also been very lucky with no big inflationary shock as we are seeing now. So going to 75 would, show that they are really repudiating their model. There is no reason to do it yet. I think it's coming, but as I said, there is going to be this capitulation, probably after the September meeting, after the summer, and that's where we could see the 75 become more likely. But now I think it's yeah.
Okay, cool. Okay, so for this coming week, what's the stuff you're watching for? But and maybe a silly question. If it's
silly,
we can almost say that till September, it's probably 50 basis points on autopilot. So why is this data so important?
Which data?
Any of the data that's coming out. I mean, obviously anything around ECI. Let's go through the stuff, but I'm just thinking like out loud. Are we on autopilot for 50 basis points? I guess the market still wants to see like some positive signs, like and if they see worsening signs, they'll have, even if 75 is unlikely in the next couple of meetings, they'll still take chances of pricing that stuff in, and at least equity markets could get really spooked and things like that. So
definitely. Because the minute the market prices 75, the Fed is in a lot of trouble. With that, with 8.5% inflation, they can't be more dovish on the market. So whatever the market prices, the Fed will have to go.
They're gonna have to,
So the data is important because it's telling us, how soon we will get to that sort of air pocket where the Fed capitulates and goes for, the 7-8% terminal rate that I have in mind. And honestly, we are not there yet.
So
what's
what's the most important data coming out, and do you deviate from, is your views deviate from the market on any of them particularly?
No, I think either the consensus seems reasonable or there is so much volatility that it's really hard to have a conviction. Like we are getting, for instance, a first quarter estimate of first quarter GDP. That figure is revised so much, and then we have the Q1 seasonality. So to me, the most important data of the week is probably the wage data. So there is this thing called the ECI.
Yep.
Sorry, this is economist jargon, employment cost index. And it's important for two reasons. The first reason is that this is a Fed preferred measure of wage inflation because it strips out a composition effect. And usually it tracks the data we get in an NFP very closely. But because we've had this huge movement in low paid employment like retail, leisure, hospitality, actually the two series are not tracking each other. So for once, the ECI is important because this is what the Fed is going to use mainly for its assessment of the strength of the labor market. And then the second reason why it's important is that typically services inflation it tracks very closely this ECI, the wage data. And so the consensus expects a small increase relative to Q4, 1.1% against 1% in Q4, which, it makes sense to me. And is well below inflation, but still it's high. I mean, we're talking about 4%, 4.5% annualized, and that really, I think, highlights one of the key issues with inflation is inertia. So when prices go up, of course, wages go up, usually not by as much. And it takes a very long time, especially when you are at 8% for wages and prices to come down. So that's a really important one.
Sure.
The other one that I'll be looking at really closely is the personal spending and data. The personal spending, because, I've been talking for a long time about a switch from goods consumption to services consumption. Right. And the data is just not agreeing with me. Goods consumption remains strong. Durable goods consumption remains strong. And so there is a possibility that the switch we saw during the pandemic is permanent, that you're not going to get this decline in goods consumption I was expecting, possibly because we've changed the way we live. The switch from goods to services is happening very slowly, which makes me wonder, people like Jim Bianco, for instance, are arguing that the work from home is a lasting change and that it means people will consume more goods and fewer services. I'm not sure, but I'm certainly looking at the data and, let's see what happens. Perhaps I was wrong. Yep. The other aspect of the personal spending and income data that's really important is a personal savings rate. So I've been harping on about that for months, but it's because that's what kept the US economy going when after the government cut transfer to household was really this big decline in the savings rate. And in my last weekly, I've been looking at the velocity of money, and a big driver of that is credit growth. And there is no question a recovery in consumer credit. So typically, when a household borrow, their savings rate goes down. And so I'm wondering if, given how high inflation is, and that, the real mortgage rate, everybody is talking about the 30-year rate at 5%, but it's still 3.5% below inflation. And auto loans are also, rates are also negative in real terms. So I'm wondering if we are not about to see a renaissance of credit that could give another lease of life to the US economy and make it even harder for the Fed to tighten. So that's why I will be looking very closely at these savings rates.
Okay, but I guess on the flip side is people's earnings are not keeping up with inflation, right?
Definitely. And so that should slow growth. People's earnings are not keeping up. I mean, the wages are not keeping up. What's supporting overall earning is that employment is still growing quite nicely.
So what would concern you from those consumer credit number? Like if it looks like people are taking on a large amount of extra consumer debt, or consumer credit card debt. Is that a good sign that people feel comfortable they can do that, or is that a bad sign that they feel they have to do that to keep up with inflation?
Well, in a way, it's both. I mean, if you look at the balance sheet of household, they've been delevering since the GFC, so they have a lot of capacity to lever. And that they are taking on more credit shows that, they feel confident enough. And funnily enough, there was a big recovery in the University of Michigan consumer confidence, completely unexpected, a couple of weeks ago. So it's good people are feeling confident. The problem is that it will keep demand high. Firms, businesses have a very strong corporate power. So it will give them more power to raise prices, and it will make the task of the Fed and possibly the recession we need to bring down inflation that much more difficult.
Yeah. Okay. Any other data for the week that look out for?
The consumer confidence from the conference board, that pickup in the Michigan index was completely from left field. So I'll be looking for confirmation of that in the conference board number, which, by the way, is not the consensus. The consensus assumes a small increase. But if I see that, and if I see more of a decline in the household savings rate, I'll probably change my view on the US economy in the short term for the next couple of quarters, for instance.
Okay, cool. Thank you. And
pleasure, as always.
Yeah, it's been great as always. And yes, good luck to all our clients, investors this week. And as always, please reach out to us on Bloomberg, email, any questions or insights or things we can improve on. So,
absolutely. Good luck, everybody.
Thank you. Good luck. Bye.